Hi, my name is Jason Dufrene, and this is my Fin452 investment strategies project. In this project, I have to choose an investment strategy, apply it to two portfolios, one with stocks that pay dividends and one that does not, and test whether or not my strategy is beneficial. So, my investment strategy is a long-term dividend investment strategy, meaning you invest in companies today that you think will be around for a long time and have great prospects and that pay a dividend. This is important because stocks that pay dividends tend to be less risky. They secure you from the anxieties of the stock market going up and down and the prices increasing or decreasing. As the prices go up or down, you always collect the dividend from these stocks, and if the stock does rise, you do collect the premium. So this means the profits don't come from the variations in the stock market like much of the investors who invest in no dividend paying stock, but from the long-term successes of the company. So once the company is generating that income, there are two possible choices for managers to take. They can either reinvest the company back as retained earnings and grow the company, or they can pay out a dividend to the shareholders. So in the companies that pay dividends, they'll get the increase in stock price and the dividends. And there are three things to consider when choosing investments that pay dividends versus those who do not. You cannot fake dividends, so if the stock prices are high in dividend paying stocks, that's a good sign because in non-dividend paying stocks, these companies can inflate their stock prices. You have to consider the length of the investment. So if you're a short-term investor trying to just make some money off of variations in the stock market, this is not for you because this requires you to invest now and receive dividends over a long time. And the third thing to consider is this is a stable capital appreciating project. As the company grows, the share price tends to grow with it, and also you'll be paid a dividend if you invest in these paying dividend stocks. And once you receive these dividends, it is important to reinvest them, grow your shares, your amount of shares outstanding, and over time increase your dividends. When choosing these stocks, which stocks to invest in, there are a few things to consider. The long-term prospects of the company, whether you think this company will be around or not, if it can pay off its debt and take care of itself. You have to consider management and their dividend policies. If the manager is investor friendly, if they pay dividends, if they skip dividends and miss some payments, or anything like that. And then the third thing you have to consider is the competition. If you think the company will be acquired or have to merge, it's not a good idea to invest in those stocks. If there's a lot of competition, you don't think they'll be around forever, it's not a good idea because in this strategy, you invest now, you increase your dividends over time, and the income you receive from these dividends, you just reinvest and purchase more stock, acquiring more dividends per stock you own, and then you just keep reinvesting. So you get a cash flow from now until the day you sell the stock and hopefully buy another stock with long-term prospects and dividends. So for my project, I have stocks that pay dividends, and this includes Disney, Apple, Walmart, GE, and Anheuser-Busch. I have stocks that do not pay dividends, and these are Amazon, eBay, Netflix, Facebook, and Google. Both of these portfolios have stocks that, in my opinion, will be around forever. They've been around for this long, and I think they'll continue being around and being profitable. So I've tracked their prices for over the past year, January of 2015 to January of 2014. I've taken their average returns, their percent changes of their returns, to calculate their average return on the portfolio per month, every month. And then finally, I took a total average of return on the whole portfolio based on these average returns per month. I did it for both stocks. I've compared both stocks to the S&P 500's average returns for the past year. I've found a correlation between these portfolios and the S&P and the returns. So, as you can see, the average returns for the stocks that pay dividends is 1.85%, which is fairly high compared to the average returns that pay no dividends, which is only 0.7%. And the correlation between the stocks that pay dividends and the market is negatively correlated at negative 0.529%. And this means as the stock market increases or decreases, this acts as the opposite. As stocks with no dividends, there's a correlation of 0.097, so it's it's negatively correlated with the market as well. But as the stock market takes a dive, you'll always receive a dividend from these stocks. This portfolio tends to move negative from the market, so if the market drops, this portfolio will rise. So there's two benefits of this portfolio compared to no dividends, which yields a lower return and less correlation. So my strategy has proven to show that you should invest in stocks that pay dividends because they have a higher return and they are less correlated with the market. Thank you.